Maria says, "Hi, Austin and Robert. I know you guys talk all the time about opening a 529 account for your children, but what about opening a 529 account for myself if I know I'm going to grad school this fall? Can I do this? Is it a good idea? I live in Indiana and I want to go to the University of Chicago and get my MBA." So this is a great idea, Maria. Yes, you can do it, but there are a couple things to consider. So when Robert and I are traditionally describing the 529 account strategy, it goes a something like this. You have a child, you open up a 529 account, investment account for them, you put money into it, you invest that money, and that money grows compound interest over a 5, 10, 15, 18-year period of time. So let's say you put in 20 or 30 grand, but now it's worth 50 or 60 because the stock market went up over that, call it decade or two. That's the cool thing. You can use those profits tax-free to pay for your education-related expenses. Now, you're saying you want to do this for yourself. You 100% can, but there's a couple things to consider. The first thing is, if you're going to grad school this fall, that's not a lot of time for your investments, to grow at all. So the first thing is, what I would do is I would put the money in the account and just not invest it. I would just use it as a way to take advantage of the second point I'm about to talk about, which is the tax deductions that come with contributing to 529 accounts depending on the state you live in. Indiana provides a 20% state income tax credit on 529 contributions up to a maximum credit of $1,500 per year for joint filers and $750 for single filers. So this applies only to the contributions in Indiana's own 529 plan, like the Indiana 529 Direct Savings Plan, for example. So if you're a single filer and you contribute $3,750, you can get a $750 tax credit for contributing that money, right? So it's like, hi, my name's Maria. I'm going to put $3,750 into the Indiana 529 Direct Savings Plan. I'm just going to keep it in cash. I'm not going to invest it or do anything crazy with it. Maybe have it in a T-bill or something in this account so it can earn a little bit of interest. But just by contributing the money into that account, keeping it there until you have to pay the money back out in the fall, you will be able to take advantage of a $750 tax credit for just doing that. So it's not life-changing money, but yes, you can do it. Yes, it's a good idea. And in Indiana, actually, it's a wonderful idea.
Yeah, I love this question, and your takeaway is really good. And just a couple things I'd like to add. Make sure you do the research in your own state, because not all states offer this tax credit, so that's important to understand. And then secondarily, yes, getting the tax credit, you might not look at it, the $750 as being life-changing, but these are the little hacks we want you all to be learning and trying to integrate into your daily lives, because it's not what you make, it's what you keep. And the more you research and find these kind of loopholes and ways to better your financial situation, the better off you're going to be long-term. Because a lot of people, I'll be honest, they're just lazy with their money. They don't work as hard for their money as they work to get it. And that's just really not a good strategy. I want people to always be looking, how can I optimize my money in the best ways for my lifestyle to give me the best retirement? And I think this is important to understand. So this is a great question. And Austin, great response.
Robert, to your point, $750 is not life-changing money, but that $750, assuming she's 22 years old, grows for the next however many, call it 45 years until she's 67 at a 8% interest rate, right? Adjusted for inflation, we're talking about 35 grand. So it's only a little bit now, but it's like every dollar that you can save using these little tips and tricks to then put and invest into your Roth IRA or your bridge account or whatever you can do turns into thousands, if not tens of thousands of dollars over a long period of time. So I just really want people to really conceptualize that. Every dollar that you're able to put away normally, turns into $20 or $30, $40, $50, $60 over your lifetime if invested correctly.
Yeah, compound interest is everyone's friend. And the more time you give compound interest to do its thing, the better off you're going to be in retirement, hands down.